Good afternoon, everyone, and thank you for joining us for the KBS live webinar and Q&A session with CrowdStreet. My name is Justin Ottman, Investor Relations Manager with CrowdStreet, and I will be moderating today's webinar. We are pleased to have the team from KBS who will discuss the KBS Growth and Income Real Estate Fund offering on the CrowdStreet Marketplace. Today's webinar will run between 45 and 60 minutes. We will first have a presentation by the sponsor, and then we will offer prospective investors a chance to have their questions answered by the sponsor. If you have a question to ask, please type that question directly into the question box on your GoToWebinar control panel, and I will ask the question on your behalf. Here with us from the sponsor, we have Peter Bren, Chairman of KBS Realty Advisors and KBS Capital Advisors, and Chuck Schreiber, CEO of KBS Realty Advisors and KBS Capital Advisors, and Lou Feldman, President of KBS. And with that, I'll turn it over to the team from KBS for this presentation.
Thanks, Justin. This is Lou Feldman. We really appreciate being with you today and the CrowdStreet Marketplace participants. Having Peter Bren and Chuck Schreiber available to speak to everyone is a pleasure, not just for me professionally, but also personally. They're iconic in the real estate world, and I've been in the field for 36 years and was the California founding partner for Goodwin Procter, and then became an investment, a personal investor in various former crowdfunding sites, now direct investing sites. And I've continued also as the chairman of the Ziman Center for Real Estate at UCLA, where Peter also serves on the board with a number of other luminaries in the field. Today, we're going to go through the history of KBS, its people, its culture, and then turn specifically to the KBS Growth and Income Fund, which is what we're offering on CrowdStreet Marketplace, and talk about the opportunity, the metrics, the properties, the protections for investors, and the ultimate decision of why invest in office properties today. So the first question I'm going to pose to Chuck Schreiber to give the listeners an idea of KBS's legacy and the quality of the company is as follows. Charles, Chuck, could you please describe KBS's legacy, its focus, and its investing principles over the last many years, and give the audience an idea of exactly who is KBS and what are KBS's principles for investing?
Yeah, thank you, Lou. This is Chuck Schreiber. KBS was formed a little more than 25 years ago. And it was formed as an investment manager to manage really value-added, opportunistic real estate investments for public pension funds. And for the first dozen years or so, that was really our focus. So we built the company with personnel that really had three different criteria. Number one, everybody who joined the company had specific hands-on real estate experience. So we didn't just want somebody who had a master's in economics from a major university who was a great thinker in the area of economics and capital markets. We wanted people who actually had hands-on, where they had a development experience, construction experience, leasing experience in not only office but retail, multifamily, even single-family properties. The second requirement or criteria is we built our organization with people who illustrated and exhibited a high level of integrity. In the real estate business, you can make as much money as you want for a short period of time, and we're long-term. And so we want to be sure we're surrounded in our offices by people within KBS who are committed to do what they say they're going to do. So that's something we wear on our sleeve. And so we've been blessed for 25 years to really have that type of culture within our company. And third, and as important, is we surround ourselves with people who have a passion for the investor. And in every venture that we do, whether it's a separate account relationship with a large institutional fund, which could be a $250 million or a $500 million allocation for a fund, or even a $50,000 investor, we have the same passion for those dollars because we view those dollars as retirement dollars, and we can't lose those dollars. And so we want to make sure that we use those dollars at a controlled risk environment where we can maximize return for the assets that we pursue. The company's built with 180 people. We're a national organization. Peter Brand is headquartered in our Chicago office, or rather our New York office. Our other office, we have an East Coast office in Washington, D.C., Central in Chicago, and we're headquartered here in Newport Beach. We have a unique company that focuses on markets. Historically, the company's had over 232,000 investors invest in KBS funds, again, whether it's separate account or in fund, with a total that's approaching $13 billion. Invest in a high percentage of those investors are repeat investors because we would go through a program where we would invest the dollars, we'd maximize the cash flow through the whole period, sell the dollars, distribute the gain on sale and the return of capital, and those investors, fortunately, would come back and reinvest with us. Currently, we have a portfolio of a little over 120 buildings throughout the country, 40 million square feet. We're about 86% invested in high-quality office, and we really focus on 56 different markets around the country. We're very, very fortunate that we have a very, very strong commercial market today with a high occupancy level, and most important, our tenants are very, very successful. Again, we have high-quality buildings, so we have high-quality tenants, and our tenants, for the most part, their businesses are doing very, very well, and in many cases, growing within our company. So I'm blessed to be a part of this company.
Peter, following up on Chuck's comments, with 232,000 investors, $13 billion in equity invested, and high-quality real estate as the hallmarks of your past, why did you choose to add an online channel like the CrowdStreet Marketplace and KBSDirect.com to your capital raising efforts?
Well, thank you for the question. This is Peter Brand. That's an easy answer, and that is virtually from the beginning, all of our investors, let's say 95% of our investors are future retirees or current retirees. Chuck and I have been dealing with the state and city and local pension funds for many, many, many years, and they are all potential future retirees or current retirees. So we understand that part of the market very, very well. The technology, as we all know, is changing extremely fast. I mean, every day you pick up the paper and you see what Amazon's latest foray is into something where they will, again, change the way people buy, people shop, people eat. And in the future, as we've all noticed, they're going to go into the banking business, so it'll be banking too. So what it does, it makes tremendous ease of access for people to organize and to operate. Today, the technology is changing so fast in the financial world that we looked at this about a year and a half ago when we saw many of the very, very small groups out there providing, let's say, a potential investment for a single building, this and that. And at that time, Chuck and I met with Lou Feldman, who we've known for a long time. Lou is the president of the real estate school at UCLA. I'm on the board of that and the board of UCLA Business School. Chuck is on the board of USC Business School, which is basically a football dynasty trying to double as a university. But they have a very good business school on top of that. So we made the decision to go give this access with no intermediary at all for the investor. So the investor is really benefiting for the first time totally without having a middle person in between the investor and the investment, which always dilutes the investment somewhat for that investor. So we made the decision to start on this. We put up We committed a sizable amount of money to do this. We committed a year and a half of our time to develop this. It's a long process, expensive process, both legally and technology-wise. Preferred to in the industry quite a bit is the plumbing. To go through the plumbing has taken us a year and a half to get through it to the point where you can push a button and make an investment. So we did this to, again, as I reiterate, for the benefit of the ultimate investor, where he is getting full benefit of his investment, which hasn't been the way it was before, as we all know. And in that change, as you know, I'm sure that all of you listening right now couldn't name a stockbroker that you once had. Everything is online. It's, as we know, it's Schwab, it's Betterment. It's all of that where you can actually choose your own investments. You can move. This one, we've gone a little bit further. Not only can you choose the investment and go to our website and actually record it individually by yourself and go online, we also have telephonic support on that, which we do 24 hours a day, basically, so that if you want to go on and make an investment or inquire, we have people on that side too. Again, we're very, very thrilled with this concept. We've made let's say, a huge emotional and financial investment in this for the benefit of the investor across the country.
Thanks, Peter. Chuck, let me turn back to you for a moment. Other sponsors are targeting investment returns of 25% or more on their offerings, and KBS Growth and Income Fund targets 10 to 14%. Why should an investor choose KBS Growth and Income Fund along with or over an investment that seems to have a higher targeted return?
Well, Lou, actually, I get this question often, and I encourage investors to really research the opportunity that's in front of them. I mean, just going through the simple mathematical program, we're currently paying a 5.5% dividend to the investor when they invest their money. So we have ongoing 5.5% yield. So if we hold a building for, let's just say 3 years, we hold the building for 3 years, and we sell the building, a $10 million building for $12 million, only $2 million gain, we're delivering a 12% return to the investor. Nearly half of that is coming on an annual basis. For an alternative investment manager to take that building in 3 years, they need to sell it for more than $17 million, or if I take that $12 million building to sell for $17,500,000 in 3 years. So to be in a situation where today we're anticipating and projecting what the sale market's going to be, the occupancy is going to be, the market rent's going to be, the cost of debt's going to be in 3 years, to get a 75% growth in value, to us is riskier than what we would accept to our investors. If we thought we could get 25% returns on low-risk investments, we'd be doing that type of business. So what we're trying to do is we're trying to do a modified risk investment in which we're trying to give a good percentage on an ongoing basis in cash flow, so the investors are knowing they're getting their return annually as they receive the cash flow. And then we select the time, whether it's 3 years, 4 years, 5 years, to liquidate the fund and return the total dollars for the overall return.
Do you have any comments on that too?
This is Peter. 1 second. Let me jump on this 1 second.
Mm-hmm.
The risk-free yield is the 10-year Treasury bond. That is considered the risk-free yield. And that's trading at 2.8, basically. And 2.8 a little change, but 2.8%. So as you are looking for yields in excess of 2.8 Treasury bonds, if you look for yields by that, your risk goes up as the potential yield goes up. So if you're talking about investing in a project that is featuring or forecasting a 25% IRR, I'm saying that's Las Vegas, because we've had those. We've had tremendous success from time to time with yields at that high. Never, ever anticipated it when we did it. Most of those were on development deals we did, not on existing buildings. We invest entirely for what we call a fairly high yielding, safe rate of return for the investor with a good upside potential. But never are we forecasting anything in that range of 25% ever.
And although some of your buildings may reach that level, you have specific targets of between 10 and 14, inclusive of that 5.5% monthly pay to the investor. And obviously the quality of the buildings and the quality of management has a lot to do with ensuring the safety of the principal and the safety of that return. Can we talk about specifics now, moving to what goes into choosing a property to be included in the KBS Growth and Income Fund, and who makes that decision and what the process is? And Chuck, I'll turn it back to you to talk about that a bit.
Well, Lou, we're very institutionalized at KBS. So we operate with 3 regional presidents, and so they work as the acquisition officers. We don't have an acquisition officer who goes out and buys the property and then turns it over to an asset manager or to a developer. The person who buys the property or manages the acquisition of the property is responsible for running the property. So we have 3 regional presidents. They introduce the investment opportunity to an investment committee, which is joined by Peter Brin, Jim Chabukas, who's our vice chairman, Mimi Nguyen, who runs all of our due diligence, our debt group, and so there's about 8 or 10 people on the committee. And we go through a full analysis of the building, and we have the investment criteria that each asset needs to meet. And it goes through this process before we really get into making the commitment to buy the asset. We're currently paying a 5% yield on investments, so obviously anything we acquire has to throw off the current yield. So the occupancy needs to be probably greater than 80%, 85, 90% occupancy at acquisition. But what most importantly during this review is assessing the risks in the marketplace. The greatest risk that we have to our buildings is new product or new buildings to be developed in the area. So if we're buying a building in, let's say, Denver, Colorado, there have been 17 office buildings built around downtown Denver in the last 24 months. Now, the occupancy of those buildings are very, very high, but that's a lot of new product that comes onto the market. So if we're looking at a new building in Denver, Colorado, we want to just make sure that there's still consistent demand to keep our tenants in the building. And so we have part of that presentation is really an assessment of the market, the amount of absorption that's taken place in the market on a quarterly basis for the last 2 years, as well as any pending development opportunities in the marketplace. And so to have that material, have that information, you actually have to be in the market and know what's going on from a leasing and development standpoint.
Can you talk a little bit about the specific buildings that are within growth and income at this point, starting perhaps with the Commonwealth building in Portland?
Sure. We were thrilled to be able to buy the Commonwealth building in Portland. We identified Portland approximately 3 years ago as a target market for us. And we were thrilled to be able to buy it. It's a little over 200,000 square feet. It's a building that actually an investor had acquired and invested roughly $15 million in the building, renovating the entire building. And when we bought it, it was 95% leased. We just believe that there was tremendous growth, potential growth in market rent. And since we acquired the property, we've seen market rent has grown 20% in the downtown area. We did some minor things to the building. We changed the lobby. We put some meeting rooms, enclosed meeting rooms down in the lobby area. There's a top building deck that we improved. There's a conference room we put on the top deck. And we took the lower floor, which is the back area, which was kind of dead area in the building, and we put bike stores. We put 200 bike racks in the building. And the support that we get today from the tenants, and more importantly, from their employees, with the enthusiasm in the building, is just terrific. We're just really, really thrilled with the building. It's just generating great yields, and it's going to be a really, really good long-term investment for us with strong cash flow, high occupancy, and we anticipate great appreciation in value.
The building that you have in Houston, the building that you have in Irvine, the building that you have in Chicago all reflect environments in which there's high growth, high job growth, and solid economics. You track the markets. How do you ensure that you don't end up, how do you ensure that your institutional nature doesn't make you less competitive because you have so many people who are focused on real estate and you're focused on specific kinds of buildings and you end up competing with others?
Well, Lou, we're, as I say, we're very institutional. There is not a conflict that exists within our company. So one thing that's unique is we'll be out investing dollars, and we have a specific strategy. We have a specific investment criteria for growth and income REIT. If an investor comes along and wants to give us an allocation to buy assets with that same criteria, we will not take that allocation. We don't believe in the rotation system. We don't believe that we should buy one for growth and income and the second for the other portfolio. We'll stick with our current fund and the current strategy, so we don't have buckets of capital to buy the same criteria. So what we're doing and what we've done is we focus on product type. You know, again, we bought the Houston asset, which was an asset we nearly didn't buy. This is back in 2016. Back in 2016, oil prices had dropped substantially. There had been over 2.5 million square feet of new office space developed in the Houston market, all pre-leased and all for oil tenants, but less than 60% of it was occupied. So tenants had committed to move into new buildings and they weren't expanding because the price of oil had dropped so much. Our perspective, we have a tenant in this building, AECOM's in almost 70% of their building. Their lease goes to 2026. And when we bought this building, we thought, what's the probability that within the next 3, 4, 5 years that oil price would get back up to $60 a foot? So that was the risk we took. We took that risk that we were confident that within the next 2, 3, 4, 5 years, oil would be back up, and the tenancy and occupancy in Houston would stabilize. So today, our cash yield on this building, our leverage cash yield on this building, is substantially above 8% because we bought it at a discount in a very challenging market.
Peter and Chuck, why are you raising a fund instead of offering individual investments on a one-off basis for investors to choose from?
Well, that's again, it goes back to what I said earlier about the fact that we're dealing primarily for pension funds who are dealing primarily for their retirees, present and future. So we have felt that all the way along, that's in our blood. Just understand that's our DNA, is to invest like this or to buy properties for this. We've bought a lot of properties over the years, as you probably know. And so the concept here to bring the great assets, great real estate at a small increment based on the fact that we can sell shares in a fund or a REIT, in this case, that has fine real estate. We continue to raise money in that fund or REIT. We continue to buy assets down the road, all good. The key to the whole thing, as far as we've always been concerned about, particularly for smaller investors, is diversification. And an investor can go out and buy, an RVs or a 4-unit apartment building, or let's say a small group of people can go out and buy a 30-unit building, something like that. But that's all in one area. So the concept of a fund or a REIT is the fact that it's geographically spread out across the country in many different areas, which are good. We have all the markets that we deal in. Southern California, for one, is sensational. Southern Orange County, Irvine area is sensational. Obviously, Portland is as good as you can go today. one of the hottest areas in the United States. Denver, Chicago, all these areas we deal in. We know them very well. We have been dealing in them for more than 20 years, 25 years. We have tremendous knowledge in those particular markets of what's going on. Our regional presidents basically are charged with of knowing everything about their marketplaces and the cities that fall into their region. For instance, a lease that is signed last week for a big tenant or even any kind of tenant in an area that we're in, whether it's Chicago or what have you, we will have that information uploaded onto our system for that lease that was signed by somebody else a week ago, some other building, so that we track the market on that basis. We'll have it in our system within 10 days of the time that lease was signed in that area, so that we continually upgrade our systems, so that when we look at an area, we know exactly what the rent is that we can get that day and what the future looks like as far as rental increases are concerned. Many of the rents we're signing today, or the leases we're signing today, have 3% increases annually, which is very good, because that's about where inflation is, maybe slightly over inflation in the last few years, but certainly inflation will be catching up to 3% soon. We're very pleased with that. Again, diversification spread out across the country so that you have a piece of many buildings as opposed to a single one is definitely the way to go for an individual investor.
Yeah, Lou, Peter is so right with that diversification. By being in a fund, we're anticipating this fund to have 20 buildings, maybe 25 different buildings, and that'll be in 12, 15, 16 different markets around the country. What it does, it gives us the ability to flee from risk. We have another portfolio that we raised funds 4 years ago. It's a sizable portfolio, 26 different buildings, and in that portfolio we have a wonderful building in downtown Phoenix. And it's at the corner of 24th and Camelback, which is the first and main in downtown Phoenix. It's a great property. We're doing projected growth in NOI on every asset in that portfolio, and through that, we believe that one asset will not achieve a 2.5% year gain in NOI over the next 5 years. And so we've targeted that asset to sell that asset out of the portfolio, take those dollars and reinvest in an asset that's going to improve. So what we do is it gives us the ability to flee from risk in the portfolio during the investment period. It just gives us great diversification.
So let's turn to what I know CrowdStreet went out and did a survey recently as to what investors seek when they are investing in commercial real estate. And one of the biggest factors is trust and transparency. It's a key factor in any direct investment, as it could be. What issues about online direct investment should investors look at, and how does KBS Growth and Income Fund address those concerns? And we can start with fees, perhaps, as the first issue, which oftentimes turns off investors.
Well, in this type of investing, I encourage the investors so greatly to spend time and educate themselves, because they're going to identify strengths and weaknesses of the investment, the real estate itself, of the investment strategy, and the sponsor by going through this. So we think that we perform better when our investors are more knowledgeable. So we're transparent. We want to disclose everything we can about the property, including the risk, including the challenges with the property, even ongoing. If something happens, if we have a vacancy in a portfolio or a specific building, I'm happy, I'm pleased to report to the investors that we have a building that went from 95% occupancy down to 75% occupancy. We're transparent, and we disclose that. Also, we have, in addition to our investment committee, we have a board of directors. And that board of directors has independent directors. So we have 3 independent directors who are not affiliated with KBS. So they have real estate and capital markets expertise outside of KBS, and we brought them together. They approve every investment that we make, every acquisition we make, every investment strategy we make, and they're actually the investors' representative at our board meeting to ensure that we're doing what we said we're going to do and to confirm we're managing the properties in the appropriate manner to maximize return to the investors.
Well, as Chuck touched on, is the word transparency is very, very important to us. Never, ever in history has the ability to have the kind of transparency that exists today, and that's entirely based on the latest, greatest technology that we all know about. In KBS Direct, as an example, for our REITs or what have you, you can go on that and find out the rent on a specific tenant. You can look at everything there is in that. It's all exposed there for you on a daily basis. You can look at your own account. You can see the yields that are coming in on yours. Any questions you have and you want to talk to somebody, we have absolutely online. We have 2 people who are online all day long who are completely familiar in our office in Newport Beach, who are completely familiar with everything. They can get you any information you need. So again, it is total transparency, which virtually didn't exist before the technology world.
Yeah, you were an early mover, Peter, and I remember at UCLA talking together about the changes that were coming, and you were right. That was a couple of years ago.
Right. Well, one of the things, Lou, too, is the fact that for the audience out there, Chuck Schreiber, Lou Feldman, and Peter Brennan are all on boards of business schools, UCLA and USC. There's also a scramble at the business schools right now on curriculum, all of them across the country. There are a few that are ahead of the game, but other than those few, everybody else has to play catch up. Many of the things that are being taught today aren't going to exist in the future. There's a huge issue about middle management. And as you follow Amazon, they're cutting out middle management everywhere. They're not going to have salespeople. They're not going to have cashiers. Not going to have anything, as you know. You just walk in, pick something up, and walk out, and it's recorded on your account. You don't have to talk to anybody, do anything. So the whole world is changing very fast. We made the decision close to 2 years ago, year and a half ago, as I mentioned before, that we want to be a leader in this industry, in the real estate industry, as far as the new technology and the ability for individual investors to invest in funds of ours, REITs of ours, that type of thing. We wanted to be the leader in it. We made the commitment to do it. It's been a interesting, arduous haul for the last year and a half. That has been headed up primarily by Lou Feldman, who's talking on this call. And because he had the earliest in his law practice as the senior real estate attorney for Goodwin Procter, he actually did most of the legal work for many of these very, very early smaller groups that were going into real estate crowdfunding. That was for kind of small investors, much smaller than we're talking about. And and he is a president of the board of the real estate school at UCLA. And again, as I mentioned, I'm on that board, so he and I talk all the time about this. And it was about 18 months ago, I said to him, Lou, what about doing this on the basis of a very, very strong, big national thing with a national company like KBS? And he just lit up. I mean, never saw a face change like that. He said, well, you'll be the first. I said, we want to be the first. We want to lead the parade in this. We do not want to be a follower. We want to be the one creating the self-driving car. We want to be the one creating everything that you're seeing right now. You know, we want to be the Elon Musk of the real estate world.
That's who you are.
So excited by it. We're, as you can hear from our voices, we're very excited to be able to be the first major company, real estate company in the U.S., maybe in the world, to offer this kind of concept.
True. You're the 11th largest office owner in the world, and you have 1,600 plus transactions under your belt, billions of dollars. Nobody else has that kind of track record, and no one else has the depth of a KBS, which is why this is such a revolutionary conversation even to be having. And CrowdStreet has been nothing but a wonderful partner in getting us where we are today as well. And without a collection of people, a mastermind of sorts, we wouldn't be here today. So it's the vision of Peter and Chuck, along with the capacity to just always be learning and always be willing to use the newest tools and not being afraid of transparency. One of the aspects of transparency that's important are the fees, and you have a very unique approach here. Can you talk a little bit about the fees and about what it costs an investor to be part of KBS Growth and Income Fund?
Yeah, where we're excited is we're delivering a product to the investor that if the investor invests $100,000, that entire $100,000 goes right into the investment, with no repayment, So there's not a commission that's paid to a rep. We're encouraging if people deal with a registered investment advisor and they have a fee-based account to deal with that registered investment advisor. We're requesting that registered investment advisor, if in the event they generally would receive some sort of upfront fee, to waive that fee. We don't have any acquisition fees. We don't have a clawback to an acquisition fee. So there's no load, but no upfront fees. So 100%, there's no reimbursement for the origination expenses, which is traditional, back to the sponsor. Peter Brennan and I are paying those expenses. So the investor puts their money in and it goes right into the real estate. So the return that they're receiving, if they invest $100,000, they start off getting a 5.5% return on that $100,000, earning that directly from the property. We have an asset management fee to run the property we get paid that on a quarterly basis. And then we have a participation
which
up
is
above
1%,
it. Once the investor receives his investor back, and above, he gets a total return above a 6%, then we participate. So our interests are aligned with the investor. We want to maximize. If we get a 15% return, overall return before fees, we make more money, and the investor makes more money. The more money the investor makes, the KBS makes more money. So we're completely aligned. So we're not being paid up front just to collect money. We have to perform on the portfolio. So I'm encouraging investors to compare that fee to other organizations, because we're in the marketplace buying assets, comparable assets. And so if we're collectively going to buy an asset that's going to generate 12% return, overall return before fees, and you compare fees and see where we're going to net out after fees, it's a really important analysis for investors to complete.
That's great. Peter and Chuck, just in terms of a macro, it's rare that people get both of you on a call or on the line to talk about assets and your investment philosophy. What's the best advice you can give to a listener about investing in commercial real estate in 2018?
Diversify. In the old days, you used to say location, location, location. I say diversify, diversify, diversify. Don't put it all in one building, one area. You need to be spread out. We're in an economic condition today in the United States I have never seen in my many, many, many years in the business. And this is a economic statement, not a political statement, but it's unbelievable. We have many factors going for us today that haven't existed in the past, and some of them are because of the problems of the past. The banking regulations mean one from the problems of the past from 2008. The banking regulations that went in, as we all know, virtually every bank in the world was bankrupt in 2008. If the governments, and particularly taking the U.S., if our government hadn't stepped in and saved them all, they'd be gone today. All right. So many rules changed and laws changed at the time after that. So the big one was that which really kind of precluded the what I call speculative building a big building and waiting for tenants to come and fill it up. That was a very, very big marketplace, and prior to 2008, hasn't existed since then. The only thing that really hurts us, or could hurt us, I should say, is that we're in a marketplace and new buildings get built all around us on a speculative basis. some buildings, a lot of buildings are being built today, but primarily those are being built for a major tenant who is going in there. No bank today, under the new banking regulations, can finance those unless there's a major tenant and the building's being done by a major sponsor. So and many banks have just completely redlined construction financing completely. So the supply that we've always faced in the past has been an issue for us, doesn't exist today. So we don't have that supply encroaching on our buildings and, let's say, limiting the upside for our rent increases because so much square feet are being offered in the marketplace. We don't have that today. So it's really good. We also have an extraordinarily strong economy that is getting stronger and stronger. They all need office space. Our occupancy on our national portfolio, I don't know exactly what it is, but it's north of 94. It's around 95. You never want it to go past that because it really doesn't give you any room, or a tenant any room for expansion within your buildings. And if they have to expand, they'll probably have to move out, which is, which again creates a little bit of an issue. But the fact is the marketplaces that we're in, if they move out, they don't have a lot of choices. So we have tremendous upward pressure on the current rental rates in all these places. Again, I see this. I can't forecast because I've been forecasting in the real estate world for more than 45 years. And I can't forecast this one, but I can tell you it's going to be a long, solid growth period in commercial office real estate. Obviously apartments too, but and we do have apartments, but nothing like we do on the commercial side. We're very, very, very keen on the future of the commercial real estate today.
Yeah, and Lou, my comment is to focus on quality. Where we're really excited about this, and even when we went in and began dealing with the retail market back in 2005, that is the retail investors, is we're giving investors an opportunity to invest in the same quality real estate that California teachers, CalSTRS, or CalPERS, or New York Common, or New York Teachers, or the state of Michigan retirement system, these large active pension funds who have billions of dollars in real estate, they're not investing in a 22-unit apartment project or a 140,000 square foot spec industrial building someplace. They're buying great quality buildings because those buildings house great quality tenants. And we know the rent's going to be paid next month on the first of the month. And that they have those tenants are successful in today's market and they're going to be long-term tenants. And so we're excited because we give that $100 or $200, $300,000 investor, or even a $10,000 investor, an opportunity to invest in the same quality building CalPERS invests in. And what it does is it gives them quality, a high level of integrity, a rent roll, quality income, and minimizes risk.
Excellent. My final question, and then I'm going to turn it back over to Justin Ottman of CrowdStreet, is what's your prediction for real estate investing over the next 12 months? It sounds like Peter's very bullish. Sounds like you're bullish. Where will we be a year from now?
I think a year from now we'll be in the same position we're in today, with high occupancy across the universe, across the U.S. Markets that were once we call secondary or tertiary markets that we like a lot have become major markets. North Carolina, we can go to Charlotte, we can go to North Hills we're in. We just to give you a little color here, we just in a development, we just built a large building in North Hills, which is a submarket of Raleigh, a big submarket of Raleigh. We just finished a building there on completion. The building was just completed. It's sold, and it's sold to a giant institutional investor. J.P. Morgan is one of them. And so it just sold on that thing. And we hit the magical 25 IRR on that. But that was a development deal that we did from ground up in that, a big project. So the fact is again, we don't necessarily put individual investors, don't go into our development deals. That's set for some of our big pension funds such as the state of Michigan, et cetera. So that was very, very profitable. We like these great areas, or like Nashville, have turned into a tremendous area to invest in. We like it a lot. 10 years ago, Nashville, we probably wouldn't have looked at it. Today, it's one of the hottest real estate markets in the U.S. Portland, we love Portland. It's just, again, I can go back 10 years. What was Portland 10 years ago? Today, you have a whole millennial world out there who is focusing on places that are kind of quality of life, as well as great locations for to operate and to work, in which to work.
Yeah, Lou, I'm excited about the market over the next 12 months because of our tenants, because we have good market growth. You know, we're in markets in which have offers, and we have existing leases where, as Peter mentioned, we have 2.5 to 3% annual growth in the in-place rents. So our net operating income automatically grows with existing tenants. And our market rent growth continues to grow in these markets, primarily because of lack of development, because of lack of competition. For the last 4 years, we've anticipated higher rates, and so we've worked with those anticipations. And so with that, we're working with our financing to try and preserve long-term low-rate debt in the portfolio. So that's an active challenge that we have to maximize the return. But it really, that hasn't dampened investors' enthusiasm. You know, the project where Peter talked about there in North Hills in Raleigh, North Carolina, we sold a building to, as I said, it was a large pension fund. We sold that building at a current yield. They bought it current yield. If they bought it all cash, that would throw off a 5.25% yield. It was $127 million. We thought the property was going to sell at $110 million, which is a current yield of about a 6.5%. So just the demand from institutional tenants, or institutional investors rather, to buy quality assets just continues on. There just aren't enough great buildings for investors to buy, or great buildings for tenants to occupy.
Terrific. Well, thank you both for the last 45 minutes of discussion. I think now that we know who KBS is and what Growth and Income Fund is providing, and the access at the low threshold that's available for an accredited investor to participate in the KBS strategies, I can turn it over to Justin, and we probably have questions from the listeners that we can address. So, Justin?
Thanks, Lou. Yes, we do have a handful of questions so far. And just as a reminder for the audience, please type your question directly into the question window on your GoToWebinar control panel, and I will ask on your behalf. And for some reason we don't get to your question today, the sponsor will be providing responses to those questions after the webinar. First question we have here is, can you provide an overview of the net asset value share price? How is the current NAV share price of $8.79 determined? What was the original NAV? And when in the future will this be updated?
Certainly. Thanks, Justin. The current value is $8.79 a share, and that was derived by going through a third-party appraiser, and they appraised all three assets. And so at the end of 2017, that came up with their opinion of market value. We acquired those assets somewhere below an $8 per share price. So we had, close to a 15% overall yield to the investors during the first appreciation during the first 2 years as we bought the property. So currently we're paying the 5.5% yield on that $8.79 a share. We will come back and we will revisit that share price on an annual basis. So what we'll do is we will reappraise through an unrelated third-party MAI appraiser and report that appreciation or the impact on the price of the portfolio and how it breaks out across through the investor's interest per share.
Chuck, you might want to also add who we use as appraiser.
Well, on this we're using Duff & Phelps, and we use them. We use them on a couple other portfolios. where I'm very, very enthusiastic about using them because they operate their appraisal program from one office with appraisers, individual appraisers scattered around the country. So it's managed by one person. The challenge with some appraisal companies is they will have a relationship with appraisers who may be employees of the company, but they run independent. So if we, for example, if we need our appraiser to complete their appraisal by the 15th of November, because we're going to put in our documentation on our documents by the 26th or 27th of November, we have to have that document. So if we have individual, because some of our funds will have 26 different appraisers. So if somebody's late, it holds up the whole process. So we've used Duff and Phelps on probably nearly half of our business in the last 5 years because of their performance of going ahead and providing and being timely and being accurate in their analysis.
Thanks for that explanation. Next question we have is, can you talk through the targeted hold period for this investment and also touch on any early redemption rights if they exist?
Right. When we analyze our assets, we do a 10-year discounted cash flow analysis on the asset. And during that cash flow, if you do a 10-year hold, because these are multi-tenant office buildings, we will have multiple tenants in each of these buildings. We have a few buildings with larger tenants, but primarily we don't have more than a tenant in 15 to 20% of the building. But as you go through and you look at as those leases roll, there may be some vacancy or free rent. It may be an interruption in cash flow. So we'll identify times during that 10-year period of time. It may be the ideal time to sell the building to maximize a return. So that sale date may be 36 months, 58th month, 81st month, and we'll highlight that and we'll manage that building for a sale during that time period. We will look to dispose of all the assets within a short period, could be 3.5 years, which is really short, to as many as 5 or 6 years from now that we would liquidate all the portfolio. We anticipate selling the assets one at a time to maximize return. We think by doing it this way, we found that we get about a 17% premium on our sale prices by handling these sales. If you think about it, if you didn't have a disposition schedule to maximize the efficiency of the building for that sale date, how do you know when to sell the building? Right? Is it just because you run out of time? Just because you started a fund and you ran out of time? So there's an opportunity in commercial real estate to create a strategic plan to maximize the price to sell the building as a very, very low risk, high level of integrity and cash flow to the next buyer, so they'll pay a premium price.
Yeah, part of the art in managing the assets is how you stack the leases so that, as Chuck just made the example, that you have a point where the building is, let's say, greatly leased, fully leased, and the fact that it's more than 90% occupied. And there's a period of time there where there are 3 or 4 years where there's not going to be much rollover of any kind. And that is something that's on our program. That is the time to sell that building. Typically, we range, as I think we said, 4 to 7 years. It's somewhere in that area. It can be 3 to 7. But, if an offer comes along that is something we can't pass, like the one we just did in North Hills, North Carolina, we will take it. But the fact is, in this case, most of this is engineered by our asset managers and our regional presidents for the optimum moment to sell that building. And it's somewhere in that 4 to 7 year period.
Thanks for that explanation. Can you describe your expectations for the rising interest rates over the targeted hold period and how you plan for those changes?
Yeah, hi, this
Sure.
is Pete. Let me just give you a thought about this. Again, I have a fun kind of running routine with UCLA Anderson School. They have a report out there that's called the Anderson Forecast. And the Anderson Forecast is a highly respected forecast that's done twice a year that they do, and it's a big deal, and they have a major law firm also backing them on that, and they've done it for many, many years. They have been wrong for the last 10 years. in every case, and I know Lou's laughing because he knows I do this, in every case, they predicted higher rates and I have predicted lower rates. And the fact is I have kind of a running battle with the Anderson School on this, because what happens is a group of economists, and I'm not knocking economists, but they're looking at computer models, and I'm looking at the world. There's a complete difference of perspective with that. When I say I'm looking at the world, you look around the world today and tell me what part of the world is in paradise and what part is not. And 90% of the world out there has serious, serious problems. So the economies, the institutions, the governments of all of those countries out there, all of them, and I'm talking about businesses, very rich people, everything else, what do? They put their money in the 10-year risk-free U.S. bond. 10 years. That's where it goes. And that the 10-year is typically the where everything is geared off of in the financial world. So they buy that bond. So as long as they're continuing to buy that, as long as we have, the North Korea issues out there, as long as we have China issues, as long as we have Russian issues, as long as we have that endless war in the Middle East, as long as other countries in Africa, everybody has problems, that money goes to the 10-year bond. So when that goes in, it pushes down the interest rate because there's so much pressure on it. So I look at that world out there completely different than a computer model. And this has gone now for 10 years. They have been wrong on that basis. And I keep telling them, get off your chair, go out and look at the world, turn on the television set, not CNN, but or any of the others, because that news has become ridiculous now with all of the pecking on each side. But look at what's happening in the rest of the world, and that money's coming in there. That keeps the lid on interest rates. I think interest rates will definitely go up a little, but I don't think it's going to be significant, or certainly not over the next year, by no means.
Yeah, Lou, our typical structure for our debt to really take advantage of the current is we take floating rate debt, so we'll do 50 to 60% financing of purchase price, and we'll do a LIBOR-based loan. And the spreads have tightened. We're within 200 basis points. So within, it may be 200 basis points equates to 2%. So it may be LIBOR plus 2%. So we're, 2.5, 2.6, 2.7% return current yield. And that's a floating rate. If LIBOR goes up, that rate goes up. So we may do a 5-year loan with a bank. And then what we'll do is we'll pre-buy a swap. We'll pay a fee and we'll buy a swap that we can convert that over to a fixed rate, and that swap today may come in at 4%. So what we do is we'll anticipate something like pay the current floating rate of 2 3/4, 3%. If it goes up 50 basis points, we're paying 3 1/4, 3.5%. But in 2 years, we can protect ourselves to go to 4% and fix it at 4% for the balance of the term and balance of the investment period.
All right, last question that we have before we're going to have to end our time today. If investors choose to invest with you, what sort of ongoing reporting and communication could they expect to receive?
Hourly.
Yeah, we have KBS Direct right here in Newport Beach. I encourage, if people have any questions regarding investment strategies, any questions regarding the investments, to call them. I mean, I'm kind of a telephone guy, so I like that. If not, go online to our website, and there is just ongoing updates as far as occupancy, as far as our rent roll is concerned, any additional acquisitions. It's all online. So it's all that material is there. We want to be as transparent as we possibly can be for the investors to be comfortable and to be knowledgeable of what about our activity and the potential success and plans for their investment.
Thank you, KBS, and thank you everyone on the line for attending today's webinar. More information about this offering is available on the CrowdStreet Marketplace by visiting crowdstreet.com and clicking the offerings banner at the top of the page. Thanks everyone and have a great day.
And we thank CrowdStreet.
Thank you, Justin.
CrowdStreet.